Hello, everyone. Welcome back to the channel. So, it is commonplace for you to hear that you cannot beat the market. You shouldn't even try. Just buy the S&P 500 and hold it to perpetuity, and you will outperform even the most sophisticated hedge funds, right? And I want to preface this by saying that buying a cheap, broadly diversified index fund like the S&P 500 is a fantastic idea, right? In my opinion, with financial markets, 20% of the knowledge is all you need to achieve 80% of the outcome. So if you have the knowledge that being in a broadly diversified index and holding it for a long time horizon, you're already 80% of the way there. And that's the beauty of financial markets. If you only care about that 80%, you could click off this video and move on, right? You can move on with your life. You could go plant your flowers or go or play football or whatever the hell you guys like to do, right? But if you want that extra, 80% of the knowledge, you can really carve out, these basis points over a long time horizon. They add up. They do add up. And really, I think it's also important to understand why the S&P 500 works, why it's outperforming the best 100 hedge funds. And I want to ask the question, is active trading really this futile? You might also be asking, why are you so interested in investing when it's so hard to outperform the S&P? Nobody's doing it for long periods of time. So why are you so interested in it? Why don't you just buy the S&P 500 and forget? Why do you have a job? Well, I'm going to get into this in this video, right? Because I think I have a very nuanced view on this topic on efficient markets. And I want to take a moment. Let's think about what active traders are attempting to do. They're attempting to generate alpha, and alpha is generated from having better, more accurate information than the other market participants and being able to act on the information faster than their competitors before it's incorporated into the market price of the security. So, for example, an active trader might sense that investors in aggregate are overreacting to a poor event, say a pandemic, for example, and they purchase the security expecting it to rebound once all the smoke settles. But then why have active mutual funds underperformed the S&P, right? Even amongst the funds that do outperform, there seems to be no persistence. If you look at the top decile mutual funds, active mutual funds, over time, they lose their top decile status. So what gives? Are these guys actually skilled? Well, the prevailing narrative at the time was that these funds merely were just lucky, right? They weren't skilled whatsoever. All that happened was that the stocks they bought just so happened to increase in value. There was no skill involved. They simply got lucky because if they were skilled, they would stay at the top. But they don't. And why don't they? Well, because they got lucky. That's the narrative at the time. And yes, I want to argue in favor of efficiency for a moment. So, market efficiency is essentially the idea that at any given time, market prices are effectively pricing in all relevant information. And what happens when markets price in all relevant information? There's no real reason for active traders to be in the market, right? They're just wasting time. They're wasting resources investing into assets that are appropriately priced. So there's no way for them to really outperform. And really, there is intense competition to bring information to the market, right? High frequency traders invest billions of dollars investing in cables that are just slightly faster so they can execute trades faster than their competitors. And then you have some firms, they have satellites looking down on the parking lots of certain storefronts in order to have better forecasts on the free cash flow of these businesses, right? So suffice it to say, the competition is so fierce, so rampant in financial markets that will make it very efficient at any given time. And this is my favorite example of efficiency. You look at prediction markets, and I know you guys have seen the ads of all the prediction markets, but did you know that prediction markets are one of the best forecasting tools that we have? Right? They constantly outperform polls, they outperform expert judgment, they outperform statistical models across a variety of different areas. And this fascinates me. In fact, prediction markets have even outperformed the internal forecasts of business operations. And what sets prediction markets apart is how they aggregate their information, right? This is the wisdom of the crowds. Unlike something like surveys, prediction markets reward accuracy and penalize the error. Traders are only going to profit if they're right, so they're motivated to act on high quality information and stay quiet if they're not confident in that information. And again, this aligns with the idea of efficient markets. If a contract is mispriced, traders will buy the undervalued contract and make a profit once it is at its fair value. And over time, that pushes price toward the true probability of an outcome occurring. And that is why these prediction markets are such fantastic predictors of future outcomes. And so it goes with financial markets, right? At any given time, the future outcome of the market price of this security is priced in due to this efficient wisdom of the crowds. And really, if markets are so efficient, why should I bother trading, right? You might be asking yourself this. Why do I trade? Why should you bother trading? Why should you bother learning? Well, first off, there's still perfectly valid reasons to trade, even if markets are perfectly efficient. It's not contradictory. There's actually plenty of good reasons to trade, even if markets are perfectly efficient, right? Some assets have different expected returns. Why? Because some assets have higher risks, right? We've talked about this in my asset pricing video. We have to look about how an asset covaries with the stochastic discount factor, right? And this is owing to the concavity of the investor utility function. We want, all else being equal, we would prefer an asset that does well in a time we value each additional unit of consumption the most. This is the marginal consumption. And when this is high, down here, when marginal consumption is high, each additional unit generates more utility, then we want an asset that will go up in tandem, right? We want an asset that exhibits a positive covariance with marginal consumption. That is, an asset that pays off in a time when they value their wealth the most, when their consumption is low. And because an asset pays off in a poor state of the world, because they're in such high demand, they will tend to offer lower or even negative returns, right? And I've used this example in several of my other videos, but I'm going to use it again because I think it gets the point across really well. When you buy car insurance, you have negative expected returns on that car insurance, right? You pay the insurer money, and in exchange, you get a policy that pays off in a time where when you crash your car, knock on wood, when you crash your car, you will be made whole financially. You're down here. That's when you're down here. When you crash your car, you value each additional unit of wealth the most, which is why I'm okay. I like this interaction despite the negative expected returns. I like this interaction because I'm getting a policy that pays off when I value my wealth the most. And so it goes with financial markets. You could also be in financial markets the car insurer, right? You could be the insurer in which you could assume a risk that other people do not want to take. In other words, the asset does poorly when the aggregate values their wealth the most. And because they don't desire those assets, the lower demand for that asset causes the implied future return to be higher, because for each additional unit of cash, for each cash flow, people are willing to pay less, or people are going to pay less because it's not valuable to them in a state of the world where they value their wealth the most, down here. And really, I talked about this again in my asset pricing video. If you want a more in-depth explanation on this, I highly recommend watching my asset pricing video. But really, what we need to be doing is analyze how an asset behaves, both in the aggregate sense. So we have to see how it co-varies with aggregate consumption. And then we have to compare how an asset behaves relative to our own consumption. And that is deeply important, even under the assumption of an efficient market. This is still a huge part of portfolio optimization, even if we assume that markets are perfectly efficient, right? In an efficient market, the market portfolio that consists of all assets held in market weights, and this is similar to the S&P 500, not exactly, but similar. A portfolio that holds assets within market weights will be optimally balancing the risk and the return for the average investor. And I'm going to put a lot of emphasis on the word average, because when I say average, what I mean is a dollar weight average, right? The average investor is the aggregate that is pricing the assets on the margin. Aggregate meaning everybody, right? All else being equal, and we discussed this, all else being equal, an asset that has a negative covariance with marginal consumption should have higher expected returns, meaning that it pays off, it does poorly when they value their wealth the most. You would not want an asset that does poorly when you value the wealth the most. So in order to compensate investors for bearing that risk, there needs to be higher returns, higher expected returns on those assets. That's formalized through this stochastic discount factor, right? So here is where a heterogeneous agent asset pricing model makes a ton of strides, right? We can analyze constraints that some groups of investors have. For example, I've brought up large intermediaries that control a large dollar-weighted proportion of aggregated wealth. And then we can make informed decisions on whether it is optimal for us to assume their risk for higher returns or hedge their risks for lower returns. So while the market portfolio could be efficient in that it's pricing in all relevant information, we still have this risk-sharing mechanism by which we can optimize our portfolio to be optimal for us, and because of this heterogeneous market that we have. We have heterogeneous risk preferences, right? Intermediaries might want to hedge, for example, they don't like illiquidity. They have a mandate to buy HQLA, a high quality liquid asset compliant assets, right? But we don't have that same constraint. We could load up on more illiquid assets, or we could load up on more stocks, right? And looking at the heterogeneity, we can make informed decisions on whether we want to be the insurer or the insurance buyer, right? The insuree. I don't know what you call that, insuree. And yeah, that's perfectly valid reason for trading in a perfectly efficient market, right? But are markets even perfectly efficient? I mean, that's a question that we need to ask, right? Because I've argued in favor for strong efficiency, but what if I told you that efficiency is a paradox? Efficiency is a paradox. Perfect efficiency is an impossibility. And this is often referred to as the Grossman-Stiglitz paradox. If you want to search more on this topic, I highly recommend looking up the Grossman-Stiglitz paradox. So I want us to think about why markets are so efficient to begin with, right? Markets are efficient because markets provide a profitable incentive for active traders to bring information to market. But what happens when information is already incorporated into prices? Well, active managers leave the market. They have the profitable incentive for them to trade is gone, so they're not going to be in the market. But what happens when active traders leave the market? Well, then market prices aren't reacting to new information anymore. And that's the paradox, right? Markets need to have inefficiencies for them to be efficient, because those inefficiencies provide a profitable incentive for active managers to bring information to market. So markets need to be inefficient for them to be efficient. And that's the paradox, right? That's the nuance here. And that is why, if you ask Eugene Fama is the man who formalized the efficient markets hypothesis. Even he admits that markets cannot be perfectly efficient. There has to be inefficiencies in the market for them to even be efficient to begin with. So what gives, right? Like, we just discussed that there's no persistence in mutual fund performance, and the vast majority of active managers are underperforming. What gives? Why would this be true if markets were truly inefficient, right? Well, the nuance is their top decile status here, it's not just the product of luck. What's happening is there's an efficient market for manager skill, right? Does that make sense? There's an efficient market for manager skill, right? The nuance is the fact that their top decile status don't remain top decile isn't because they're unskilled or just simply got lucky. Their skill attracted capital to the fund, and because strategies can't scale, they can no longer deliver long-term alpha to their clients net of their fee. So really, their top decile status was their downfall. The fact that they were skilled was their downfall. They brought capital to their fund, which reduces their alpha because their strategies are incapable of scaling. Again, remember how I said how active managers are buying mispriced assets? Well, each time they go long or they go short, that moves the price of the asset slightly closer to the fair value. As the fund's capital, the assets under management, increases, they're going to have a larger price impact on the underlying asset that they're trading, which means that they're going to have less and less and less alpha the more and more capital flows to the strategy. And this is why there is no persistence. It's not because they're just simply got lucky and it was all luck. No. It was because they were skilled, capital flowed to that skill, and because capital skill cannot scale, or their strategies cannot scale, the alpha must decay. This is what's known as alpha decay, right? Once people know that a strategy or a manager produces alpha, then capital will flow to that manager until the alpha decays to zero, right? And what happens here is we see that, like, when a manager has a small amount of capital, they're going to produce a lot of alpha, right? And alpha isn't just a measure of manager skill, right? Alpha can also be an indicator that too little capital has been allocated to that skill, right? When a manager is skilled but has huge amount of capital, they will struggle to outperform due to that price impact that we talked about. And a great example of this is Warren Buffett. He's one of the most widely known successful traders in the world, but he's not immune to alpha decay, right? He has hundreds of billions of dollars in his fund. And not only that, Warren Buffett has been pretty open about his strategy on how he trades. So we have billions of more dollars flowing to an identical strategy that he is employing, right? And because of this, Warren Buffett has failed to outperform the S&P 500 over close to 2 decades now. And does that mean he's unskilled? No. Warren Buffett is extremely skilled. But what happened is he's managing a gargantuan fund. And there's even billions of more dollars deployed to using a similar strategy that he has deployed. So while Warren Buffett can be incredibly skilled, there's too much capital to where he's incapable of even leveraging that skill to generate alpha. And that's really the paradox. It's the paradox of skill here. Really, the skill was his downfall. The skill is what attracted capital to his fund, which is what created his downfall. And you look at someone like the Medallion fund, right? The Medallion fund has had insane performance over its lifetime with no sign of stopping. And how is he doing that? Well, what he did is he capped the fund at $10 billion, and he keeps his industry secrets airtight. Airtight. So that's how someone like him can remain generating alpha in perpetuity. And what we see here is that the net alpha, so the average manager is adding about $2 million worth of value every year. But there's extreme skew. So the median manager is destroying about $240,000 of value every year, but the average is generating about $2 million every year. And the interesting thing is that approximately 80% of the active managers are generating returns in excess of the fees. So most of them are most of the economic rents accrue to the skilled manager in the form of fees, which means that these managers are actually capturing most of the value they're creating. Now, whether that goes to investors is actually not really going to investors. Most of the value is accruing to the active manager. So if you are someone who's looking to invest in an active manager, it's the same thing with investing in an undervalued stock. You need to be finding an undervalued manager. You need to be finding these managers until too much capital flows to the manager, lest you will be succumb to unimpressive alpha, like net of fee alpha of 0% on average, right? So really what I'm highlighting here is that you need to be adaptive, right? You can't be married to a signal. You can't be married to a manager. Because what happens, here I have a sample of 212 peer-reviewed factors, right? Peer-reviewed predictors of returns. These are anomalies, and I have the 5-year compound annual growth rate of each of these anomalies. And here I aligned the dates based on how far it is from publication. 0 here is when the paper was published. This is before it was published. This is after it's published. And you see here this inflection point. What happens immediately following the paper's publication? The strategy decays. And this is for the exact reason we talked about earlier, right? Alpha decay. Alpha decay is so important for people to understand, right? Alpha decay, as capital flows to these signals, as capital flows to these managers, the alpha eventually decays over time. And it doesn't mean these managers are unskilled. It doesn't mean that active trading is futile. It just means you need to be adaptive. You can't be married to a signal. And if you do find a signal, you shouldn't be publishing it for everyone to see. You shouldn't be sharing it for everyone to see. You should be keeping it simple. You should be keeping it secret, not simple. You should be keeping it secret. You shouldn't be sharing it to the world. And really, you just have to be adaptive. And maybe this is a topic for another video because I don't have it here in my notes. But Andrew Lowe, he popularized this idea of adaptive market hypothesis. And it's kind of the same idea where markets have these inefficiencies, but the moment they're discovered, they're gone. I mean, not immediately. It takes time for them to disappear. But you need to act quick, and you need to be constantly creating and retiring new models. You can't be married to a signal. You have to be constantly evolving and adapting over time to be a successful trader in financial markets. So really, what I want you to take away is that while these managers are underperforming, it's less so because of luck. It's more so because their skill was their downfall. Their skill attracted too much capital, and because their strategies cannot scale, that causes their alpha to decrease. And can you trade? Is it still reasonable to trade? Yes, but you have to be adaptive. You can't be married to a signal, and you have to keep it a secret. I know you want to share it with your friends, but really, if word comes out about your signal, then it's too late. I mean, the competition is so fierce. It is such a fierce competition to where if you find a signal, you gotta keep it to yourself. Otherwise, that alpha is gone, right? So anyways, that's my idea about efficient markets, basically a synopsis. I think markets are very efficient, but they're efficient because there are inefficiencies in the market that provide a profitable incentive for active traders. That makes it perfectly sensible for someone to trade actively, assuming you're willing or able to take those risks and are smart enough to know when to retire or create a new model.